ever wonder what it takes to become successful in real estate investing? When I was just starting out, I was amazed by the number of acronyms that were out there. They reminded me of my good old dental school days when I was constantly trying to figure out all the new terms and abbreviations. Take NOI, for example. When I first came across this, my dental brain immediately came up with nasal-oral infection. But in the real estate world, NOI stands for net operating income, which is a crucial metric in evaluating property's investment. Now, in this video, we're going to look at why the NOI is so important in your real estate investing journey. If you're new here, I'm Dr. Jeff Anzalone, a periodontist on a mission to get you out of the rat race with passive income. Do me a favor, download the passive income guide below this video. And please don't take any of this as financial advice. Check with your advisor or your tax professional. All right, let's get right into it. NOI, or net operating income, it might sound complex, but it's just a very simple calculation that helps you understand the cash flow and the profit potential of a rental property. It actually gives you the big picture of the property's annual income streams after you subtracted out the operational expenses. Importantly, it doesn't factor in the debt payments, the taxes, the depreciation, the mortgage interest payments, and the capital expenses, aka the CapEx, which makes it a more reliable indicator of revenue potential, especially if you're comparing two properties. Now, speaking of that, if you understand how NOI works, it becomes even more critical when you're actually going out there and looking at multiple different properties. In the commercial real estate sector, a property's price isn't based on the surrounding or the comparable properties like it is in the residential market. So for instance, if you bought your house, let's say your house listed for $250,000. Well, you look at what the comparable houses in the area went for. 300,000, 275, 225. So you're looking at the comparable prices. In the commercial real estate, not based on the comparable prices. Instead, it's based on what we're going to talk about today, the NOI. This means if you're choosing between two RV parks, the one with the higher NOI might be the better investment. But how do we calculate this? The formula is this: gross operating income plus other income minus the operating expenses. To more accurately calculate the NOI, here are some of the different terms you need to consider. The first one is being potential rental income. Now, this is the total amount of income generated if a property was 100% occupied, okay? And as you might expect, the likelihood of a property being rented out 100% of the time is very low. The second is something called the vacancy loss. This is exactly what it sounds like. This is the potential rental income lost due to vacancy. This could be from you having to evict somebody or just a natural process of a tenant turning over. Many of the real estate syndications that I've invested in, they typically use a pro forma or a projection vacancy rate equal to 5% of the potential rental income. Now, the next one you have to look at is the effective rental income. Now you want to subtract out, if you're subtracting the vacancy loss from the potential rental income, this is going to give you the effective rental income. All right. Now, other income is going to be things like pet fees, late fees, laundry facilities, that sort of thing. So then now you have the gross operating income. So if you combine the effective rental income, which was, remember, the potential rental income, what's the potential I could get on this property minus the vacancy loss. So if you take that, combine the effective rental income plus any other income, you're going to get the gross operating income. Take this number, you subtract out the operating expenses like taxes, insurance, maintenance, that sort of thing. That's going to get your NOI. It's important to remember that the rental income isn't the only source of revenue. Your property can generate income from sources like laundry facilities, self-storage, covered parking, snow removal, vending machines, even Wi-Fi. Let's help you kind of bring all this together with an example. All right, Dr. A is trying to set his son up with a good investment as he's heading off to college. So he suggests his son buy a fourplex near campus. And this particular fourplex is actually renting out each unit for $1,200 a month. This generates, remember, we have the potential rental income. So the potential rental income is going to be $1,200 per unit. It's a fourplex. So 1,200 times 4 is $4,800. If you take $4,800 a month times 12 months, that is the potential rental income. If this thing stays occupied 100% of the time, 24/7, 7 days a week, 365 days a year, the potential rental income is $57,600 a year. Now, this particular fourplex also has coin-operated laundry machines that it's going to add roughly about $1,000 per year in other income. He factored in a 10% vacancy loss. So if you take this 57,600 times 10%, that gives us the 5760. All right. This is going to bring the gross operating income to $51,840. So if you take the 57,600 minus the vacancy loss, that's how we're coming up with that. Based on the current owner's accounting operating expenses, they're $12,000. Now we can plug all these numbers in to find out the NOI. So when we're looking at this fourplex, after it's all said and done, what are we expecting? What's our net operating income? So we plug in our formula. Gross operating income was the $51,840 plus the other income. Remember, the other income was the $1,000 from the coin operated laundry. All right, so you got that. Subtract out the $12,000 in expenses. All right, so now that's going to give you an NOI of $40,840. Now, understanding NOI is vital as it comes into play into several other calculations, one of those being the cap rate. Let me explain. The net operating income assists investors to determine the cap rate of a property. All right, this is a metric used to evaluate the profitability metric of a real estate investment. Typically, investors use cap rates to quickly compare the ROI, or the return on investment, on different types of property they may be considering buying or selling. These may vary by rental rates, construction type, and location. A good rule of thumb about cap rate is this. Typically, the lower the cap rate, we'll just abbreviate it for CR, the lower the cap rate, typically the higher the value or the purchase price. And the inverse is true. The higher the cap rate, the lower the value. So let's look at the cap rate formula. These are calculated by taking our good old friend NOI, net operating income, and we're going to divide it by the market value. So the cap rate equals the NOI that we just discussed, how we get the NOI, divided by the value or the purchase price of a property. Now, if the NOI isn't provided, it can be calculated by taking the income received after expenses have been paid, but before the principal and interest payments, capex, depreciation, and amortization. All right. So remember, whether you're an experienced real estate investor or just starting out, understanding the real meaning behind all these different acronyms will help put you on the path to success. So don't let all the jargon overwhelm you. Take it one step at a time, decode the acronyms, and soon you'll be fluent in the language of real estate investing. Now, I know that we very, very briefly talked about what a cap rate is and how to calculate it. But if you want to learn more about this very important metric as well, plus how the real pros use it when investing in real estate, check out this video.